Hi, my name is Wentong. I'm an economics PhD student from Cornell University. I'm going to present my paper, The Power of Reserve Tiering, Financial Institution Heterogeneity, and Monetary Policy Pass-Through. Central banks typically have reserve requirements to ensure that financial institutions are able to meet the liabilities in case of the sudden withdrawals. And the central banks pay reserve rates to get control over the interbank rates, such as the federal funds rate. For example, in the US, the interest on the reserve balance IORB is 5.15% with no tiers. And the reserve tiering means that the financial institution's reserve holdings at the central bank below a certain threshold are remunerated at an upper interest rate, while the reserves above the certain threshold are remunerated at a lower interest rate, which is typically negative. And many central banks have implemented the negative interest rate policy with the tier system. For example, Switzerland's SNB, ECB, BOJ, Denmark's National Bank have implemented those reserve tiering. If we look at the BOJ's case as an example, BOJ implements a three-tier system in which for each financial institution's reserve at the central bank, for the basic balance, BOJ pays 0.1% interest rate. On top of that, BOJ pays 0% interest rate. And on top of the macro add-on balance, the BOJ pays a negative 0.1% interest rate. Different financial institutions have different reserve balances and get exposed to different interest rates. So why central banks implement this reserve tiering? According to the ECB, the two-tier system aims to support the bank-based transmission of the monetary policy while preserving the positive effect that the negative interest rate can have. And the interest rate cut within the low interest rate environment after the global financial crisis is typically not very powerful. This is because the deposit rate has a zero lower bound. Banks are reluctant to cut their deposit rate into the negative territory, and as a result, banks face a shrinking interest margin, which hinders the monetary policy pass-through. And reserve tiering accompanies this negative interest rate policy to reduce the hurt to the financial institution's health will promote the monetary policy pass-through to the loan market. So, my research questions are, how does reserve tiering affect the monetary policy? How does reserve tiering bring changes to the monetary policy pass-through? And what is the mechanism behind that? Is reserve tiering good or bad? Does reserve tiering bring changes to the economic welfare? And in what ways can the application of the reserve tiering be extended to the broader contexts? And I will present some data and I'll use a model with heterogeneous financial agents and two markets to understand this. My paper contributes to the literature by formally modeling the connections between the interbank and the loan markets to understand the transmission mechanism of the reserve tiering. And the reserve tiering policy is not well understood by the past literature, and my paper characterizes how the heterogeneous rate exposure to the tiered system can impact the monetary policy pass-through to the loan market via different channels. And my paper can help to understand the loan rate distribution changes following the policy, which I will show very soon. And also, my paper provides a more generalized framework to understand the policy implications in different country settings and economic conditions. So, if I look at the BOJ's case as an example, what happened in the loan market after the reserve tiering? On the horizontal axis, I have the loan interest rate. On the vertical axis, I have the loan amount. And the before and after the reserve tiering, the loan rate distribution changes gradually from the blue curve to the red curve. And we can observe most of the changes happen within this area. So I'll zoom in this part. And we can see that after the reserve tiering is implemented, 4 months after the reserve tiering, there is a sharp increase in the low interest rate loans and a decline in the medium interest rate loans. A natural question to ask is, who suffers the negative interest rate balance? And there are some stylized facts about the BOJ. Firstly, investment trusts and other institutions that following the Japanese law, they cannot offer loans to the market and receive deposits from the market. They have a higher negative interest rate balances. And I call those institutions non-depository institutions. And for banks, big banks such as the city banks and the trust banks, they typically have higher negative interest rate balances than the small banks following the BOJ's policy design. And in the interbank market, big banks and non-depository institutions lend more and borrow less to avoid those negative interest rate balances after this reserve tiering is implemented. And the small banks borrow more because they have more rooms in their reserve negative interest rate balances. And as a result, the heterogeneous interest rate exposure allows small banks to get extra cheaper funding from the non-depository institutions and big banks through the interbank trading to offer loans. And in my model, there is a central bank which determines 2 tiers. To simplify the analysis, I model a 2-tier system rather than a 3-tier system like the BOJ's case. The central bank determines the reserve requirement KI for each financial institution I, and also determines a reserve tiering threshold MI for each financial institution. And for the financial institutions reserve at the central bank, above this threshold, the central bank pays a negative rate, which is RR, and below that threshold, the central bank pays a regular rate, which is RM. If the financial institution cannot meet the reserve requirement, the central bank offers a lending facility in which the financial institutions can borrow from the central bank at the rate Rx to meet the reserve requirement. And in the model, at t equals 0, the central bank sets the reserve requirement and reserves a threshold for all financial institutions with the initial reserves R. And at t equals 1, the interbank market opens, and the banks trade with the trading volume delta I, which is positive for the borrowers and negative for the lenders. And the non-depository institutions have the trading volume delta tilde, and this is negative due to the pre-policy balances. And the banks trade with both banks and the non-depository institutions at the rate R delta. And at t equals 2, the banks faces the deposit shocks. And the banks receive a IID deposit shock, epsilon I, and the bank's reserve after the shock is YI, which is the RI, the pre-shock reserve balances, plus the interbank trading volume minus the deposit shock. And at t equals 3, the central bank lending facility is implemented. So if the reserve is below the requirement, the bank I will borrow from the central bank lending facility at the rate Rx. And there is a continuum of banks of measure 1, and the bank's profit function pi I is composed of 0 parts. Firstly, the cost in the interbank market, which is the interest times the lending volume, and the reserve interest they receive at the regular rate from the central bank, and the reserves with the negative interest rate they receive from the central bank. And also, if the bank's reserve cannot meet the reserve requirement after the deposit shock, they will borrow from the central bank lending facility. So this is the lending facility cost. And banks offer loans to the market and it gets the profit loan rate RL times the loan volume LI, and bank has a chi function, which is the loan cost. And banks pay interest RD as the deposit rate times the deposit DI minus the epsilon I, which is the total deposit amount after the shock. And also, banks borrow from the capital lenders at the rate RE to finance the loans. And the bank's problem is bank maximized expected utility by choosing the interbank trading volume delta I, loan volume Li, deposit volume Di, and the capital amount Ei. Banks face three constraints. The first is the balance sheet constraint, which means the total asset equals the total liability. The second is the capital requirement constraint, which means the capital should be greater or equal than Q times the bank's total asset. And the third is the deposit rate. And the deposit rate has a zero lower bound, so it should be greater or equal than 0. In the model, there is a measure gamma of non-depository institutions, and they have predetermined balances exceeding the negative interest rate threshold and tiled, and therefore they receive the negative interest rate for sure. And they are maximizing their profit pi tiled, which is composed of the reserves interest received at the central bank, minus the interbank trading cost, minus the capital cost. And they have two constraints. Firstly, is their reserve balance is a portion times the total capital they have. And the second is their balances at the central bank is greater or equal than the negative interest rate threshold. And the non-depository institutions choose the interbank trading volume and the capital they borrow from the capital investor. And there are some entrepreneurs in the market. Entrepreneurs have loan demand, and they want to borrow from the banks to finance the risky projects they have in hand. And they will only borrow if the project return RP is greater or equal than the loan rate. Therefore, their loan demand is an integral of the project return H and integral from the loan rate RL to the upper bound of the project return RP upper bar. And therefore, there is a downward sloping loan demand curve. Intuitively, when the loan rate is higher, the loan demand is lower. And there are some depositors in the market, and the depositors have an upward sloping deposit supply curve. And even if the deposit rate is 0, the depositors have some deposit supply. This is to mimic the condition that there are some cash hoarding cost for the depositors. There are some capital investors in the market in which there are inelastic capital supply at the rate RE, and this rate RE is greater than the deposit rate RD. Interbank market, deposit market, loan market, and the capital market is clear. The reserve tiering pass through to the loan market via 4 channels: liquidity channel, interest rate channel, bank interest margin channel, and the loan risk reallocation channel. I will look at those channels one by one. The first channel is the liquidity channel. The liquidity channel means that there is a positive relationship between the loan rate and the non-depository institutions' reserve tiering threshold and tiled. And intuitively, when a non-depository institution's reserve tiering threshold declines, the non-depository institutions have a higher portion of the negative interest rate balances at the central bank. As a result, they want to lend out more in the interbank market. So banks have extra liquidity to finance their loans, and therefore the loan rate declines. And for the central bank, the reserve tiering threshold for the non-depository institutions is a new policy tool to promote the monetary policy path-through to the loan market. And the second channel is the interest rate channel. And in equilibrium, there is a positive relationship between the loan rate and the interbank rate. And this is the regular interest rate policy pass-through channel. And when the policy rate declines, the interbank rate declines, and the loan market rate declines following that. And the intuition is like when the interbank trading rate declines, banks have a cheaper funding source in the interbank market to offer loans. And the partial derivatives give some policy implications. When the reserve tiering threshold M and the reserve requirement K is low, it is optimal for the central bank to cut the negative rate and the lending facility rate. So intuitively, when the gaps between the reserve tiering threshold and K, the reserve requirement is low, it means that it is higher likely the financial institutions will have a higher balance of negative interest rate. So it is optimal for the banks to cut the interest rate for those balances to promote the monetary policy pass-through. Also, when the reserve requirement is high, it means that it is more likely financial institutions will borrow from the central bank lending facility. Therefore, cutting the lending facility rate is more optimal. And this is supported by the partial derivatives derived. And the third channel is the bank interest margin channel. And in equilibrium, the deposit rate and the loan rate has a positive relationship with each other, and at the same time, the loan rate declines faster than the deposit rate. So intuitively, banks cut the deposit rate more than the loan rate, and the deposit rate will achieve the zero lower bound very soon. So when the deposit rate approaches the zero lower bound, the expected profit of the bank can be approximated by a quadratic function of the loan rate RL, and the optimal loan rate can be solved as a function in which the first term is negative, and there is a item which is the aggregate trading volume of banks. And since banks are net borrowers in the model, this term is positive. Therefore, the loan rate declines. And if we look at the chart, it's like for the horizontal axis, we have the loan rate. For the vertical axis, we have the bank's profit function. It's like the bank's profit function shifts from the blue curve to the red curve, and the optimal loan rate declines. And for the next channel, I need an extended model to focus on the heterogeneous bank settings. And there are three modifications of the previous model. The first thing is that there is a one-to-one matching between banks and entrepreneurs. Each banks have a different risk preference, and each entrepreneurs have a project with different risk exposure. And each bank with the different risk preference is matched with the exact same risk exposure entrepreneurs. And under the constant return to scale assumption, this one-to-one matching holds. And the second assumption is the idiosyncratic portfolio return CDF. And suppose the entrepreneur I gets loans from the bank I, and the portfolio return is a uniform distribution CDF with a different heterogeneous support because of the riskiness of the project. And therefore, we have a new parameter H, so which is the risk aversion level of the banks. So if the H increases, it means that a bank is more risk averse. And the third assumption is the loan rate distribution assumption. In equilibrium, each bank has a different loan rate and an additional constraint. So there are heterogeneous loan rate and loan amount in the market for each bank. With those three additional assumptions, I can characterize the fourth channel, the loan risk reallocation channel. And when the deposit rate is close to zero, the optimal loan rate for bank I is a function of the bank's risk exposure. And there is a positive relationship between the bank's loan rate and the bank's risk aversion. And therefore, for banks with a higher risk exposure or lower HI, they cut the loan rates by higher magnitudes. And intuitively, a risky bank or a small bank, they have a higher leverage, and therefore they have a lower reserve balance, and therefore they have more room to borrow in the interbank market, and they get a cheaper funding inflow to offer the loan rate cut. And it means that there is an increase in the systematic risk, because for the higher risky loans, now the loan rate is lower because of the higher magnitude loan rate cut, and therefore higher risk loans are offered a lower risk premium, and therefore more lendings go to the risky borrowers. There is an increase in the overall risk in the loan market. However, the central bank can deal with this issue by increase the lending facility rate, because risky banks are more likely to face the bank runs, and therefore they have to borrow from the central bank to meet the reserve requirement. So increasing the lending facility rate can deal with this risk. And this loan risk reallocation channel can also help to explain the loan risk distribution changes. And the lower risk portfolio, they face a lower magnitude loan rate cut until they hit the zero lower bound. While for the medium risk portfolios, they face a higher magnitude loan rate cut, so they squeeze towards this direction. While for the higher risk portfolios, they face a very high magnitude loan rate cut, but it is unobservable due to the low volume. One question we may ask is, nowadays we are far from the zero lower bound, so how can the reserve tiering be implemented today? And my answer is, the order of the interest rate on different tiers matter. And to cool down the overheating economy, the central bank can remunerate the reserve above a certain threshold at a higher rate instead. That is to say, the top tier interest rate RR is greater than the regular rate RM. I call this reserve tiering with ascending interest rates. And as a result, the loan rate RL will increase due to the opposite directions of the four channels. So if we look into the details, for the interest rate channel, the bank's financing is more expensive, so they have less incentive to offer more loans. And if we consider the liquidity and the bank interest margin channel, when the interbank rate is greater than the top-tier reserve balance rate, non-depository institutions, they are net borrowers and the banks are net lenders. And as a result, the aggregate trading of the banks is smaller than zero in the interbank market. So the optimal loan rate with the first term as a function of that aggregate trading volume of banks, this whole term will be greater than zero, so the loan rate increases. And when the interbank trading rate is greater than the top-tier interest rate, both banks and the non-depository institutions, they want to lend out. And therefore, banks get no extra funding from the interbank market. So the loan rate, it will increase. And the third channel is the low risk reallocation channel. And when the interbank rate is smaller than the top tier interest rate, the lower risk banks are net borrowers and higher risk banks are net lenders in the interbank market. This will result in a higher magnitude loan rate increase for higher risk banks. And as a result, more lendings go to the safer borrowers, and the financial system risk declines because an increased risk premium for the bank loans. Compared with other policies, reserve tiering with ascending interest rates have many advantages. So firstly, it works through the additional liquidity and low-risk reallocation channels than simply raising the interest rates. And compared with the increasing reserve requirements, reserve tiering with the ascending interest risk can help to stabilize the financial system health by letting the market function. And because more lendings go to the safer borrowers, or alternatively, the central bank has to adjust the policy carefully to achieve the same result. And finally, this reserve tiering is less costly than open market operations and quantitative easing. To conclude, my paper uses a model with heterogeneous financial institutions and two markets to characterize how reserve tiering promotes monetary policy pass-through via four different channels. And the non-depository institutions' lower interest rate exposure to the tiered system allows banks to get extra cheaper funding from non-depository institutions through the interbank trading to offer low interest rate loans. And the banks with a higher risk exposure can cut the loan rate by higher magnitudes due to the additional funding from the less risky banks. And there is an increase in the systematic risk due to the lower risk premium for the higher risk banks. That's all for my paper. Thanks.